Welcome back. Today we will see about options. The two types of options, the main two types. One is the call option and put option, and the payoff of options, and how the payoff graph works, and what is the break-even point. Everything we'll see in detail. So this is the introduction slide. You can see the options buyer. There are two parties specifically involved in a transaction. As one is buyer and another party is seller. So in case of options, the buyer has the right, but not the obligation to exercise. But in case of seller, the seller is always have an obligation to give the delivery of the underlying. So in this case, the buyer has the limited uh, loss, which is the upfront premium, and in case of sellers, it is the premium which is collected. It is going to be as profits and is going to incur the losses till the stock prices reaches zero. So that is its maximum profit zone. Even though it is limited, its profits are limited to zero. So you can see here the option is not equal to obligation. The reason is not both the parties have the obligation. Only one party is having the obligation. That is nothing but the seller of the options. So call options is predominantly used when the underlying is expected to move up in price, and put options are predominantly used when the underlying is expected to fall in price. So that is the basic difference between these two. You can see here the call option is predominantly used to when the underlying price is expected to move up, then the call is the right option to be selected, and in case of put, when the underlying price is expected to go down, put is the right option. So where we are using the options in our live, these are some of the live examples. Say for example, we are using it in real estate films. So why in case of real estate? Say for example, we are entering into an agreement saying that I'll buy a so and so property initially for a sum upfront premium, say $5 million. The property overall worth is somewhere around $50 million. So after 3 months, if the housing prices crash and the house price came down to 50 million to 10 million, so we will not exercise that option because our strike price is somewhere around 50 million, but the actual market prices came down to 10 million. So in this case, we leave that option worthless. We'll incur that 5 million loss and we'll buy the real estate in the cash market. It's nothing but in the market itself for 10 million. So in this case, we have saved almost around 40 million. So this is one of the same example. This is the way even the option stock markets work. So even though this optionality is predominantly used in across asset classes, say for example convertible bonds, the bonds need to be converted to stocks, then there should be an optionality. So either it can be in this case it's a call option. So you can, once you're converting the bond, you can call for the stock at a so and so convertible price. So this is just an example before going into the payoffs, just for the better understanding terms. To reiterate again, so when we are going to use it, you are going to use it when the price is expected to increase in case of call, and put when the prediction of the price decline. Okay, so coming back to the payoff, this is one of the simplest form of graphs, and it is the most powerful graphs because if you know these two graphs, you can form almost n number of combinations. I would say n number of combinations you can in case of the option strategies. So in FRM or CFA, this optionality subject is predominantly used. Now coming back to the example, say for example our strike price of the option is $10 and the premium is $1, and we are the buyer of the option here. Okay, so the underlying price is currently at $10. Okay, so we are expecting the stock price is going to move up in the direction. Okay, we are expecting the stock price will move up beyond $10. For that we have paid the premium of $1. So in this case, if the stock reaches to 12, so if the stock reaches to 12, what happens? we are paid a premium, upfront premium of 1. So the difference between stock and strike is 12 minus 10, which is nothing but 2 here. So just to rewrite it again, say for example, uh, our stock price is 10 here and the strike is also 10, and we are paid a premium of 1, which is not negative for us, which is a cost for us. Okay, so in this case, if the stock moves beyond 10, say 12, so we have the right to exercise this option at 10. What I mean by exercising, I can buy the underlying at 10, still I can buy the underlying at 10. So our cost is, so we'll be paying 10 and our net profit is 2 here. But you can see here we have paid the premium of 1, that is our actual cost here. So 2 minus 1 will be the $1 profit. Okay, so this is the actual example. So coming back to the graphs again, to be more precise, so this is how it looks. Our stock price is 10 here, so 9, 8, 15. So in this case our premium is $1 is the premium which we have paid, so it is negative sign, it's our cost. So if the stock is staying at 10, we'll be losing minus 1. If the stock is staying at 9, we'll be losing, our option will be worthless. If the stock is staying at 8, we'll be losing at 1. So when we will start making profits, when our option will break even, so once the stock move beyond 11, so actually at 11 our cost is our stock plus premium put together, which is nothing but 10 plus 1, 11. So this is our break-even point. So we'll be start making profits once the stock moves beyond 11. Say if the stock goes to 15, we'll be making, say the stock goes at 15, we are paid a premium of $1, so our net profit is somewhere around, the strike is 10, so the difference is 5 minus 1, which is 4. The 4 will be our profit. So that is the actual phenomena behind this options payoff. So even here it is being represented, even it is represented, so in this below tabular column, the stock, profit and exercise option. So when we are going to exercise the option, we will be exercising the option only if the stock price is more than the strike price, then only we will exercise the option. Otherwise no use in exercising the option, because we can buy the underlying cheaper in the market if the stock price is way below than the strike price. So coming back to the we have seen now the one type, which is we have bought the option, so we are expecting the price to move up, so we have bought the option by paying the upfront premium of $1. So when we are buying an option, there should be a seller, so there should be a counterparty who is providing that option. So the counterparty is nothing but the seller. So in option markets we call them as option writers, predominantly the option shorters. These people are the shorters of options. So why they short options? They short options because they expect that the stock price will not move beyond the strike price. So they do this because they collect the premium. So in this case, if you are buying an option for $1, the option seller will collect that $1 premium. So over time, if the stock is not moving any direction, will be start making profits. Coming back again, say for example, this is the graph now. So the underlying is at 10, 9, 8. These are all the series of prices. We call it as price series. Okay, so on and so forth. So this will be our $1, $2. Okay, so as an option writer, our profit is limited to 1. Why it is 1? Because that is the maximum amount of premium which have been paid by the buyer and we have received it upfront. Okay, so if stock is staying at 8, which is way below the strike price, the option buyer will not exercise the option, so we'll be sitting at $1 profit. This is a profit zone. Even it is 9, the reason is even if the stock is at 9, still we'll be sitting at $1 profit, because the stock price is less than strike, and even at 10 I would say the stock price is equal to strike, but still will be receiving 1. The reason is the buyer has paid upfront premium, still upfront premium of $1, still the option is not in the money. That's the reason we'll be making profit even if the stock stays at 10. So when we'll be start losing money? So for us, the no profit zone, no loss or no profit zone is 11, because we have received a premium of $1 upfront, right? Even if the stock moves to 11, since we have received an upfront premium of 1, so 10 plus 1, $11, will not be in loss, will be in no profit or no loss zone. So once the stock falls, will rises. Once the stock moves to 12 or 15 or 100, our loss is unlimited. So we have the obligation to give the stock. Say the stock reaches 100, still we have the obligation to sell the stock at the strike price of 10. So we'll be incurring a loss of $90, but we have received a premium of 1, so our net loss is $89. So this is the difference, basic difference between the buyer of options and the seller of options. The seller of options carries the predominant risk in the option markets. The buyer of the options, their losses are limited, but still the premiums are low. Instead of buying it in cash markets, they usually prefer this due to the magnitude of gain. In case of option writers, the magnitude of losses are very significant, because for a small amount of premium, they are doing this transaction. The reason they do is, say for just for an example, if we have only 2 days or 3 days to expiry, the option is trading at a premium of $1. They know the markets will be range bound, so they can collect this premium upfront. They can collect the premium with the help of time decay. They know this option will be moving close to zero, so that's the reason they short the option, and they will collecting the premium, and this option price will be zero, and they'll be enjoying the profits. So that's the reason. Hope it helps. So please comment if you have any observations, and please do follow it. Let me see you in other session. Thanks.